In the spring of 2020, as the global economy abruptly shuttered, a bizarre phenomenon occurred at the highest echelons of global finance. Hedge funds, massive commercial banks, and multinational corporations didn't rush to buy gold. They didn't flock to Bitcoin. In fact, they didn't even want United States Treasury bonds. In a terrifying 2 week span known as the Dash for Cash, the world's most sophisticated investors liquidated everything they could at virtually any price just to hold physical, unyielding dollars. They were willing to take guaranteed losses on their portfolios for one simple reason. When the music stops, liquidity is the only oxygen in the room. We are frequently told by financial pundits that cash is a terrible investment. We are reminded that inflation silently erodes our purchasing power, and that keeping money under the proverbial mattress is a guaranteed path to wealth destruction. This is mathematically true, but fundamentally incomplete. Today, we are going to tear down the conventional, elementary advice of saving 3 to 6 months of expenses. We are going to examine the concept of the emergency fund not as a static piggy bank, but as a dynamic tool of personal treasury management. By the end of this video, you will understand the precise mathematics of personal liquidity, the catastrophic cost of forced liquidation, and how to calculate the exact dollar amount required to immunize your portfolio against macroeconomic shocks. To truly understand how much cash you need, we must first stop thinking like consumers and start thinking like a central bank or a corporate treasury. Every household is essentially a microeconomy. You have a balance sheet, you have cash flow, you have capital expenditures, and you have operating expenses. In corporate finance, there is a constant tension between two forces: liquidity and opportunity cost. Liquidity is the ability to meet your short-term liabilities without taking a loss on your assets. Opportunity cost is the potential return you sacrifice by holding a safe, low-yield asset instead of a riskier, high-yield asset. When you hold cash in a savings account, you are intentionally choosing to suffer a phenomenon known as cash drag. If inflation is running at 3% and your bank pays you zero, you are actively losing 3% of your purchasing power every single year. From a purely theoretical standpoint, every dollar you own should be invested in a compounding asset like equities or real estate. But here's where economic theory collides with the friction of the real world. Liabilities are absolute, while asset values are relative. If your car engine explodes or you require an emergency medical procedure, the mechanic or the hospital does not care about the current valuation of your stock portfolio. They require a fixed amount of fiat currency immediately. If you do not have the liquidity to meet that liability, you are forced to bridge the gap. In the financial world, bridging that gap usually happens in one of two ways. You either take on high-interest, unsecured debt, like maxing out a credit card at a 24% annual percentage rate, or you are forced to liquidate your investments. We call this a duration mismatch. You have a short-term, immediate liability, but your capital is locked up in long-duration assets designed for a 20-year time horizon. An emergency fund, therefore, is not an investment. It is an insurance policy. The premium you pay for this insurance is the yield you sacrifice by not having that money in the stock market. You are accepting a small guaranteed loss to purchasing power in order to prevent a catastrophic, permanent loss of capital. It is the buffer that allows your compounding assets to remain entirely undisturbed by the chaos of your daily life. Let us examine the unseen engine of the macroeconomic cycle and how it dictates your exact need for cash. The greatest flaw in the 3 to 6 months rule is that it assumes financial emergencies happen in a vacuum. They do not. Financial shocks are highly correlated. Imagine you are holding a portfolio entirely in the S&P 500 and you decide you do not need an emergency fund. You are fully invested. The economy is expanding, corporate earnings are robust, and you feel secure. Then the credit cycle turns. The central bank raises interest rates to cool inflation, the cost of capital spikes, Corporations, suddenly facing higher debt servicing costs, begin to contract. They lay off workers. Because you work in a cyclical industry, perhaps technology or advertising, your position is eliminated. You have just experienced a severe personal income shock. But remember the macro environment. Because interest rates have risen and corporate earnings are falling, the stock market is simultaneously experiencing a heavy drawdown. The S&P 500 is down 25%. Because you have no liquidity buffer, you are now forced to sell your equities to pay your mortgage and feed your family. You are selling assets that are down 25%. This is the deadliest sin in wealth accumulation. Forced liquidation during a bear market. Let us quantify this. If you are forced to sell $20,000 worth of stock at the absolute bottom of a market crash, you have not just lost $20,000. You have permanently destroyed the future compounding power of those shares. If the market historically returns 8% annualized, that $20,000 would have become roughly $93,000 over the next 20 years. By not holding a basic cash reserve, a short-term disruption cost you nearly $100,000 of future wealth. So, how do we calculate the exact amount you actually need? We abandon generalized rules and look at your personal income beta and the rigidity of your cost structure. Beta is a measure of volatility. If your income has high beta, meaning it fluctuates wildly, is heavily reliant on commissions, or is tied to a highly cyclical industry like venture capital or construction, you are mathematically required to hold a much larger liquidity buffer. Your income is highly correlated with broader market downturns. In this scenario, 12 to 18 months of bare-bones living expenses is not conservative. It is necessary. Conversely, if you possess low beta income, perhaps you are a tenured professor, a government employee, or a healthcare worker with high job security, your income is decoupled from the stock market. A recession will likely not affect your paycheck. You can afford to run a much leaner balance sheet, perhaps 3 to 4 months of fixed costs, allowing you to deploy more capital into compounding assets. The second variable is the rigidity of your expenses. We must divide your outflows into structural costs and variable costs. Structural costs are your mortgage, property taxes, essential utilities, and groceries. Variable costs are dining out, vacations, and subscriptions. Your emergency fund should only be calculated against your structural costs. If a shock hits, you will immediately cut the variable costs anyway. The calculation is simple. Take your absolute minimum monthly burn rate, multiply it by the estimated time it would take to replace your specific income stream in a depressed economy, and hold exactly that amount in the highest yielding, purely liquid instrument available. To see these mechanics play out, we need only look back at the great financial crisis of 2008. This was a masterclass in the destructive power of correlated shocks. Leading up to 2008, American households were running incredibly lean on cash. The personal savings rate plummeted to near zero. Why hold cash when home equity was climbing at double digits every year? Homeowners essentially used their houses as high-yield savings accounts, relying on home equity lines of credit, or HELOCs, for their emergency liquidity. Then the subprime mortgage market fractured. The contagion spread from Wall Street to Main Street. Between late 2007 and early 2009, the S&P 500 collapsed by over 50%. Unemployment doubled, eventually peaking at 10%. Here is where the duration mismatch destroyed households. When millions of Americans lost their jobs, they reached for their emergency liquidity, their HELOCs. But banks, terrified of their own insolvency, immediately froze those credit lines. The liquidity vanished exactly when it was needed most. Without cash reserves and without access to credit, households were forced to liquidate. They sold stocks at generational lows. Worse, they defaulted on their mortgages. The cascading wave of foreclosures further depressed housing prices, creating a vicious, self-reinforcing downward spiral. The wealth wiped out in 2008 wasn't just due to falling asset prices, it was the permanent realization of those losses through forced selling. Those who held cash rode out the storm, kept their assets intact, and participated in the longest bull market in history that followed. Now, contrast 2008 with the unprecedented shock of March 2020. When the pandemic lockdowns were announced, the velocity of money, the rate at which dollars move through the economy, effectively dropped to zero overnight. In a panic, corporate treasurers acted immediately. Companies like Ford and Boeing completely drew down their multi-billion-dollar revolving credit facilities. They didn't even need the cash that week. They simply hoarded it because they understood that in a total systemic freeze, cash is the sole determinant of survival. This corporate behavior mirrors the exact function of a personal emergency fund. During those chaotic weeks in March 2020, equity markets plunged 34% in a matter of days. If a household did not have a cash buffer, the sudden loss of income would have forced them to sell shares at the exact bottom of the pandemic crash. However, households that maintained a strategic cash reserve were able to simply pause their investments, pay their structural costs with their emergency fund, and leave their portfolios untouched. When the Federal Reserve intervened and markets violently rebounded, the prepared household suffered zero permanent capital loss. These historical events prove that an emergency fund is not a dead asset. It is a highly active defensive mechanism that prevents the liquidation of your wealth at the most economically disadvantageous moments in history. When we zoom out to the macroeconomic level, the concept of the emergency fund creates a fascinating economic paradox known as the paradox of thrift, first popularized by the economist John Maynard Keynes. If one individual builds a robust cash reserve, they are financially secure. But if every single participant in an economy suddenly decides to hoard cash at the same time, slashing their consumption to build emergency funds, the broader economy collapses. One person's spending is another person's income. A mass dash for cash causes a severe recession. Therefore, a healthy, functioning capitalist system actually requires a delicate balance. It needs capital to be continuously deployed into risk assets and consumption to drive innovation and growth. Yet it requires individual households to maintain enough personal liquidity to prevent localized shocks from cascading into systemic financial crises. So, how much do you really need? The answer is not a platitude found in a personal finance book. It is a rigorous mathematical output based on your specific life architecture. It is your structural, non-negotiable monthly burn rate multiplied by your personal income beta, adjusted for the volatility of your industry. If you hold too little cash, you expose yourself to the catastrophic ruin of forced liquidation. You allow a temporary loss of income to permanently impair your net worth. But if you hold too much cash, hoarding years of expenses out of irrational fear, you fall victim to the silent, compounding tax of inflation, entirely missing out on the wealth-generating engine of global equities. Your emergency fund is the financial moat around your castle. Calculate its depth with precision, fund it ruthlessly, and then, once it is full, never let another dollar sit idle again.